Okay, we're off and running today at the Global Property Market Real Estate Forum here in Toronto. This is the Commercial Real Estate Podcast powered by First National. I'm Aaron, he's Adam. This is a fun one at the Global Property Markets. We don't do this every year. We've done it a number of times in the past. One of the most recent times we had Jose Pellicer on in a different role. I like doing these global property markets because it's a totally different perspective.
Out of our comfort zone, different view.
And to be fair, I think I've referenced Jose, we'll hear from him in a second, in maybe a dozen podcasts, because I regularly will reference, this one time this guest Jose said, and I quote you on just, the impact of ESG on investing and the way that real estate, sort of is viewed sort of from a global perspective.
Jose is your European real estate guy.
Yeah, he's the only one I've ever really had a chance to. I hope you're right, because I've quoted you quite a bit. Anyway, Jose, thanks for joining us.
Well, glad to be here again.
You switched jobs. Today you're now at Evanite as a founder and partner. So maybe let's just start there. And we're not going to do Jose's background this time around. If you want to go, I would suggest. It was one of my favorite episodes, really it was, hearing Jose's perspective, running a very large European sort of institutional investor, throughout the globe, right? It wasn't just in Europe. So a very interesting perspective. But today we're going to be talking about his new role and the startup. So maybe, Jose, let's just start with, what's with the switch? Why leave the comforts of a pension fund and multiple billions of dollars at your fingertips to go to a startup with no billions at your fingertips?
Imagine, I must be crazy probably. Yeah, I must have lost my mind. So I was at M&G. I wasn't running M&G real estate, but I was the global chair of the investment committee and global head of strategy, and I looked after the ESG and product development team. So I had a relatively senior role, let's put it that way. And I left it all to start this startup, Evanite. So let me tell you a couple of things about Evanite first. So the name, it looks a bit strange, that word doesn't exist. Actually, we're 5 founders, and all 5 founders, we used to work in a company called Rockspring. Rockspring was a pan-European value-add real estate investment manager that was sold in 2018. Rockspring's logo was an ammonite, that is a fossilized sea snail shell. And therefore the name Evanite is the evolution of the ammonite, Evanite. And basically, the idea it tries to convey is that this is the evolution or the next generation of pan-European real estate investment managers. So that's the name.
I love a clever name. That's
there
that's
we
great.
go.
Yeah.
There we go.
That's a good start. Yeah.
So we actually, that took a long time to find the name. We all have favorite
And you can't do anything
names.
else, right, until you get the name.
And the .com has to be available, and it's all.
Oh my God! No,
How many names did you pick before you ended up on Evanite?
Oh my God! No, that was amazing because we actually ended up with a voting system. Each of us suggested 3 names, and then we had a voting system in which we had to pick something like 4. And then the top 8 would go to the next round, and then we would vote 3. And, so we had first round, semi-final, final, and then we picked the name.
Well, good. Well done. It's a good name.
There we go. So, the voting system was the main innovation, or the first innovation that Evanite did. So now you asked me the why. Why did we do this? So I think that you don't leave a big role in the investment management industry to go for a startup with no pay, self-funded, if you don't have a purpose. And the purpose we had is the following. We've seen other private real estate investment managers in Europe come and go. At some point in the middle of their life, they start increasing AUM, increasing the amount of products, and setting themselves up for sale, to the detriment often of clients, to the detriment. So the conflict of growing AUM to the detriment of performance. When you have a small company ethos and you grow very quickly, you lose sight of the actual investment and what is good for investors. That's our first bugbear, like, AUM growth for the sake of AUM growth. Our second bugbear, and it's my own in particular, is risk. I have seen over and over again, as real estate cycles get hotter and hotter and hotter, you have a return target. And then in order to reach that return target, as the cycle gets hotter, you start taking more risk, and more risk, until everything ends in tears.
Which part of the cycle are we in right now? Are we the tears yet, or what's the?
Not yet. We're at the beginning of the cycle right now. But the point is that everyone's fixated on target return, but nobody thinks about risk and about measuring risk. So one of the things that I said as an investment philosophy to this business is I want to spend as much time in every investment committee talking about risk as talking about return. And I want every vintage to have its own risk category. This sounds a little bit nerdy, I'm sorry, but we had two bugbears. AUM growth for the sake of AUM growth and for the sake of selling the business. We don't want that. We want to focus on performance. And bugbear 2, return, same return, regardless of the risk. No, we want to focus on both return and risk. Those were my big bugbears to start something new, something fresh. And let me say one last thing. Like I see you open your mouth, so before you ask the question, let me say just one thing. Every private real estate investment manager in Europe that was born or existed in the 2010s has been sold, or rumors say is about to be sold. And
sold to who?
Sold, I just say rumors, but has been sold to bigger players, to
pension
institutional players.
Funds, yeah.
Not necessarily to pension funds, so to bigger managers.
Okay.
To bigger managers. And that has created a vacuum in the industry. So I think that the field is ripe for a new breed, a new generation, an evolution of privately owned, fully aligned real estate investment managers. There we go.
Before we go, I want to talk about your clients and just the client attraction and just what that looks like. But how do you quantify risk?
Do you really want the nerdy answer?
Yeah, we're lenders. Are you kidding me? Like
we think about downside all the time.
Oh my God. Okay. So look, it is very hard to quantify risk at transaction level. A lot has to rely on judgment. The secret is, or the trick is, or the art effectively is, to have a set of rules that are consistent across deals and have a framework that can be applied to every deal. So risk in real estate, as you both know, entails the following: liquidity risk, can I sell the asset? Vacancy risk, so is the tenant
cash flow durability?
Exactly. Yeah. So is the tenant going to go bust or is the tenant going to go at the end of the lease? And depreciation risk.
Finance risk should be on the list too.
And leverage. So those are the 4 typical risks. Now, how do you measure and what kind of subcategories do you put in? This depends on the investment manager. You need to have a model, but you need to have a set of rules that always apply. And therefore you can create a consistent score. Let's put it that way. But let me be very, very open here. So this is an art. This is not a science. And this is not quantifiable. This is a score based on a number of qualitative facts.
And a lot of it's gut instinct too.
A lot of it's judgment. It's judgment based on a set of rules. It's like when you are in a trial, right? You've got code law, right? So you base the reality that you see on certain description of reality that is codified by the law, which is based on a number of principles. Sorry, I sound so horrendously nerdy, but that is based on a number of principles. So that's how we think in terms of risk.
In the current environment, is there more of an outlook of downside risk or upside gain right now?
That's a very good question. So we are at the beginning of the cycle. We had between 2022 and 2023, or the beginning of 2024, we had a big downturn in real estate and a big repricing. So we are in a situation where we are at the beginning of a cycle right now. in the beginning of a cycle, you tend to see mispricing. And when I say mispricing, what do I mean? What I mean is that certain risks are cheap. Now, just take the global financial crisis, which is, the easier place to start with. In the global financial crisis, everything was cheap. Everything, there was a lot of uncertainty. Every single sector, every single country was cheap. However, if you had deployed capital into shopping malls, which were cheap, that potential opportunity wouldn't have materialized. You would have lost a lot. And then comes COVID, you would have lost even more. However, if you had invested in logistics, if you had invested in offices, if you had invested in apartments or residential, you would have made a killing because everything was cheap. So the fact that some risk is cheap doesn't necessarily mean that the return is going to come. It just means that it is cheap. In the case of retail, risk perception was the correct one. It was right that it was cheap. But in the case of offices, it wasn't. CBD offices were very cheap. If you had bought a CBD office in 2010 and then sold at some point in the next 9 years, you would have made a killing. So now we're in a situation that is not so clear-cut. Certain risks are cheap, certain risks are not cheap. So let me give you one example. So logistics, that's perfectly priced, that's fully priced. That, the risk of investing in logistics is not cheap. But power centers, convenience retail, that risk is now cheap. For example, rents have rebased, liquidity is beginning to come back. And we saw in the conference today a very interesting chart that for Asian investors, retail is the number one sector at the moment. So retail is slowly coming back up the charts, but it's still priced very attractively. So, that's a very long answer, but just to understand, at the beginning of each cycle, risk tends to be cheap, and then you need to take advantage of that, of the risks that are cheap and are wrongly cheap. So in Warren Buffett's, lingo, is the market value is lower than the intrinsic value of an asset.
How do you measure cheap? Like spread cap rates over interest rates? Like what's the way that you view that cheap? Like how does that?
Like how do you capitalize on it?
Yeah, well, and I like how do you quantify it? And then at what point does it no longer become cheap?
Oh my God! Well, look, I mean, here's my rule of thumb. So if you're in core real estate, my rule of thumb is if you take the risk-free rate, your total return on the asset you buy has to be roughly 400 basis points above risk-free rate. That's for core. That's for real estate. That's good quality, right? Now,
that's your leverage return.
That's your
unleveraged return.
Unleveraged return. Unleveraged return.
So we're talking about cap rates.
Yeah. So no, unleveraged return, including growth, including rental growth.
Okay, great.
Total return has to be 400 basis points, right? That's my rule of thumb. That has been true in history roughly since 1985. Right? Just give or take 400 basis points, right? And then if you add an extra risk on an asset, let's say that you need capex, well, then it needs to be cheaper. Or let's say that the location is a little bit off, then it needs to be cheaper. Then let's assume that it's a development, then it needs to be cheaper. So let me give you another silly example. So there was a time where the gap between, let's say in 2012, 2013, I was active in Germany. In Germany, in food retail, in Germany, long lease, let's say 15 years, the cap rate was in the region of 5%. For a short lease, let's say 3-4 years, the cap rate was in the region of 7.5%. Okay, inflation-linked leases. So just releasing risk was very cheap, historically, right? So when you have this data and when you have the history, you make a judgment because at the end of the day, we're in the real estate market, so it's all about judgment.
What's your asset mix now then? I'm trying to figure out exactly where you're seeing the opportunities coming into this next cycle. So where are you deploying your capital? What's the asset mix? If that's proprietary, then we'll ignore it. But where do you see the opportunities?
Well, look, I mean, this is a startup, so let's be clear. The startup, so Evonite has existed only for 5 months, and we have been allowed to speak to investors only 2 months ago. So
Like regulatory reasons why?
let's call it non-competes.
Okay.
Yeah.
So yeah, maybe I like Adam's question, but maybe before we go to the investment strategy,
Yeah.
let's talk
Why are
about
you getting in my way, Eric?
yeah, let's talk about the capital raising exercise and what it's been like as a startup. I mean, there's 5 of you. You've all got relationships, I'm sure, throughout. But what's it been like to try to get money in and try to I mean, you've been probably sitting in front of a lot of people explaining your new investment philosophy.
Well, that's a very good question, because effectively, in the world of real estate right now, the market is extremely polarized. So let me give you one piece of statistics. I'm not completely answering your question, but I'm going to come back to your question in a second. So if you look at the whole capital that was raised for value add in Europe, so targeting Europe, in the last 5 years, 40% of it was raised by just 2 groups, by the top 2 groups. So 40, if you are the third group, you get into 46, 47, according to Preqin data. So the market is extremely polarized. The investors want to invest with the managers they know, right? So there is a massive barrier to entry for startups. So let's put that in there. Now, second point. So because Evonite partners, we've all worked together at Rockspring for over 10 years. We've all we've all managed, or we've all delivered a fund series, a value add fund series called the Trans-European Fund, of which 7 funds were raised. So therefore, in a way, we are a new old manager. We're a
Rebranded.
Let's call it, it's not rebranded because it's a new business, right? And it's not a rebranding of an old business, but it's basically 5 people that come from different places that have got together again and share a track record. It's a track record that we don't own, but the headlines of the track record are public information. So we are a new old manager. So just to put that out there.
You can leverage the success of those funds.
We will leverage the success of those funds. So the key achievement of those funds, I know I'm not answering your question.
No, it's okay.
The key achievement of those funds is that in bad vintages, they didn't lose money. And I think that's a very big thing, right? They didn't lose money in bad vintages because they didn't take excessive risk. Okay. Now, I'm going back to your question. So therefore, in terms of the reception we've had, we've only been allowed to speak for 2 months, right? The reception we had has been very good. Everybody sees us as an old new manager. So the key first risk that we were taking as a business is, are we going to be seen as a startup and as a new manager? Are there going to be investors who are willing to pick up a fight with their investment committee and say, no. These guys have delivered. I know them, right? So the reception so far has been very good. So a number of investors have access to our portal. They're looking at the documents. So, it's early days, but reception has been amazing.
Who are the target investments?
Investments or investors?
Investors, thanks. Yeah.
Investors. Okay. So, so in terms of target investors, what we want in order to create a business that is long-term and that is there, that becomes bigger than us, and that it's there when we retire, and that is based solely on performance, the key is to create a partnership with your investor, a long-term partnership with, say, 10 to 15 investors that are there with you over the different vintages, give or take, right? So we know they're there, they know we are there for them. So the first point of call is the investors that have invested in the Trans-European series. First point of call. Second point of call is investors that either are in different jobs or have analyzed the Trans-European series and were very close to investing. And point of call number 3 is investors who have invested in different strategies in Rockspring, but maybe not in the Trans-European series. So this is, let's say it's a pool of, let's call it 30, 35, of which we want to reduce to say 10, 15, that are there for the ride. And that is the key business model we want. We want to have a small suite of investors that are there with us for the.
And are these private wealth individuals, companies? Like what's the, or is it everybody?
Usual
Anybody?
institutional investors, right? Pension funds, insurance companies.
Well, I was thinking that when you're talking about like the focus on managing the downside risk, like that speaks well to pension funds and groups like that.
Yeah, exactly. I mean, we're in the value add world. The value add world, you can see actually in my panel, someone said, look, you need to look at capital flows. And you look at so at investor flows, right? In periods where there is a lot of investor flows, that's where you know, okay, this might be of advantage. There's loads of capital to buy and limited amount of buildings to sell. That's where you say, okay, let's bring the risk down.
Go against the flow.
Go against the flow. That's it.
Yeah, that makes sense. So what's the next then? What's the next steps?
Well,
You've got to raise the capital and then start finding the opportunities.
Yeah, so raise the capital for a maiden value add fund that will be supplemented with co-investment transactions in the key verticals that constitute the investment strategy, and then invested throughout the years 2025 and 2026, which should be years of.
How much are you trying to raise for
very
that
good
fund?
vintage, 500 million. 500
Minimum.
million.
Minimum.
No, I mean hard cap of 6-ish.
Yeah. Okay.
Yeah.
And then throw on leverage and you're into $1 billion something worth of purchases.
Say, yeah.
Okay.
Yeah.
You talked about perfect pricing in the market for certain asset classes. I guess for others, the market is disjointed, or there's opportunities there. Are you going to avoid the perfectly priced markets once you've got this capital, or is there still opportunities to squeak out an edge there? Or what's the thought?
So listen, in the world of value add, as you know, an asset that is fairly priced is only attractive if you predict phenomenal rental growth, because there is something in the macro, micro characteristics of this asset that make you conclude that there might be phenomenal rental growth potential. I don't think we're there. We're there. Early cycle value add vintages are all about mispricing. So let me give you an example. So basically in the world of logistics, we're talking about logistics. Logistics is fairly priced, but that doesn't mean that the whole industrial sector is fairly priced. So there are areas, as I said in the panel earlier, that small industrial transactions that under 10, 15 million are generally give you a cap rate advantage of around 100 basis points relative to a logistics asset above 25,000 square meters. So historically, up until 2019 or 2018, they were priced exactly the same. And now they've diverted. Why have they diverted? Because most managers don't want to waste any time
on the smaller stuff.
Just
liquidity component.
Well, I was thinking that we talked about two groups sucking up almost half of the capital raise over a period of time. They were trying to deploy that. Like, they can't mess around in $20 million purchases. It does handcuff them a bit. They can only focus on the largest transactions.
Exactly.
So if they're all concentrated in the largest transactions, that leaves some room in the, call it sub $100 million category.
Or even lower. Or even lower, exactly. But at this point in the cycle, it's all about investor demand versus supply of deals.
We should ask you about ESG and the impact. That was one of the big sort of revolutions, I would say, last time we chatted with you. That's where you quoted a bunch of times. Because 3 years ago, obviously we were all talking about ESG, but and I would say it's still true predominantly in Canada, where there's still a misunderstanding or a reluctance to acknowledge the impact of ESG on real estate valuations and real estate, just the approach that we take as a community to real estate. You, from European roots and European experience, we're talking about, it's out of a totally different world where if there's a high cost to carbon or a high cost to decarbonize that asset, it's worth much less in a European environment. I don't think that's still true in Canada. Forgive me, Adam, but how often do your clients talking about, the ESG impact on buying a new apartment building? It's not really a major issue, but in Europe it is. Maybe just talk about how this fund is approaching ESG, and maybe just expand on some of the comments you made 3 years ago.
Well, I think that ESG is just a fact. It's just part of the world in Europe.
We have no
at the
incentives
moment.
here, though, Jose. Like that's the thing. I think.
CMHC Finance has incentives.
That's fair. Okay, so for apartments exclusively, if you're mandating some energy efficiency or decarbonization, you do save on the premiums and you get slightly bit more leverage. But
and
there's
very minor and non-CMHC, probably maybe 5 basis points on spread, but that's not
yeah,
significant.
but in Europe, there's tax implications, right?
Yeah. Well, in Europe, let's put it that way. So, in terms of energy efficiency, there is a regulation that basically say that by 2029, anything that has an EPC, energy performance certificate, that's worse than a B, cannot be let. You cannot let it by law, forbidden, right? So
That's catastrophic for return.
imagine, right? So if you have anything today that has a D, you better do something about it.
So who controls the ECP? Who does that? Is that a federal or is that a European Union? Who mandates that? Who registers it? Who controls it? Who owns
That is
it?
a national thing, and every country takes it in a slightly different way, but they all have a version of a European regulation.
Right.
Yeah, but it materializes, to make it more complicated and more frustrating, differently in different
So they all
countries.
calculate the scores somewhat differently.
Exactly.
But
Based on
ultimately,
NF.
the across the continent, there's a rule where you have to have a certain score
Exactly.
in order to lease
And they're
it.
all known and done now. If a market hits the property, this is not a certificate needs to be done. All properties, you know their score going into the purchase.
Oh, yeah. You cannot sell a property without an EPC, even a residential property. My house has an EPC,
What's your rating?
right? Man, my house has a D.
Oh no!
I have trouble selling
I'll buy it for
if I
10
wanna
cents on the
sell
dollar.
it. So every property needs to have an EPC. So, but that's just one example. The other example is the net zero pathways, right? Every property now, if you want to sell a property that is above a certain size, your buyer, if it's institutional, will want you to do a net zero audit that includes the cost of decarbonizing the asset along the pathway. What I mean by that, okay, you're looking at me strangely. So this means that let's assume that your emissions are here. In order to be net zero by 2050, so there is something called the CREM pathway that calculates how your emissions should be reduced all the way to zero by 2050. And so one is like the theoretical pathway, and the other one is your actual emissions now. If your actual emissions are above the pathway, you better do something about it.
Right. There's a cost to it.
There's a cost to it. Now, there is something called the low-hanging fruit. So if you just change the lighting from, normal bulbs to LEDs, that already reduces the emissions a lot, right? So low-hanging fruit is cheap. That's really good. But once you've done the low-hanging fruit, comes the difficult thing, which is change the boiler from gas to electricity, right? That's very expensive.
Yeah.
Right?
Like-
in an office. In industrial, particularly in small industrial, there's tons of low-hanging fruit because nothing's been done so far. So therefore, that is a potential opportunity as well, low-hanging fruit that can be rentalized.
To get onto the zero carbon pathway.
Meaning,
The 2050
The
target.
2050 target.
do you get into
Yeah,
it?
I mean,
It is possible. I mean, if you buy a new building now that has electric heating as opposed to gas, you're well, within.
so if
the
you're buying a
pathway.
gas building, you've got 25 years to get there.
Exactly. You've
But-
got exactly.
But if you're building something brand new from scratch today, would you just target net zero currently so you're already there, or is it you'll make it up further down the road?
Too expensive.
Too expensive. Okay.
Too
You're waiting for
expensive.
technology to catch up.
Exactly.
Okay.
So that is exactly very good point. So most of the pathway, most of the interventions. So if you have something that is around the pathway by 2040, right? The assumption is that technology will change in a way that will allow you to get you to net zero. So, when you buy something, you don't look beyond 2040, 2035 because you assume that the technology will change.
It's amazing to think what a larger part of the process of an asset revolves around ESG than here. Every time we talk to you, this is the big takeaway is, again, Europe is light years ahead of where we are.
It is crazy. It is crazy. But mostly offices and residential. In industrial, particularly small industrial, very little's been done. In retail boxes, very little's been done. Even in Germany, you know, gas was the rule of the game before the Russian invasion of Ukraine. Now Germany is beginning to change. Well, loads of things are changing in Germany right now.
So that must weigh on an asset class. You're saying industrial is known to be the furthest behind, I guess, out of the kind of four main food groups. That must weigh on valuations. That this entire asset class essentially is an outstanding liability of billions and billions and billions of dollars that needs to go into it. Like, would you factor that in? Would you notice that in a price differential if it did not have that requirement?
I think it's more obvious in the world of offices because people have thought about offices a lot more. In the world of big industrial, big logistics, I think there is a little bit of that. In the world of small industrial or, you know, retail, that hasn't been very liquid in the last 5 years. It's still, as you were saying, in North America, like it's not yet totally factored in.
Jose, it's a pleasure as always having you on. Always eye-opening, and you know, it's interesting to have you on at this stage in your launch. I mean, we could have you back on in 8 months, probably have even more of a different conversation than we had today. And on a personal note from Aaron and I, we always love hearing about people leaving large institutions to do their own thing.
Yeah, I'm jealous.
We got
no offense to anybody working at First National. Hope my boss isn't listening.
So very cool to hear about, and we look forward to capturing you again. You know, when you're here in Toronto, if we got a bit of your time, one of the future global property markets. But we should thank our host here today, the Real Estate Forums, for having us at the conference, First National, for powering the podcast. But most of all, Jose, thank you so much.
It's been a pleasure. Thank you so much.